Hi there. Welcome once again to Alternative Investing. Remember, this is the show where we go beyond the normal stocks and bonds and mutual funds, and we look into investments usually require a bit more capital, but the main thing is they're designed to zig when the general markets zag. They have a zero correlation, or as little correlation as possible, let's say, to the regular public investments. We are talking about things like private equity, real estate for capital growth or for income. We're talking about hedge funds, and these are areas that we don't explore enough, and we're very excited we can get into them more. Let me introduce you once again to my co-host, regular Friday co-host, David Kaufman of Westcourt Capital. Great to have you here.
Pleasure to be back.
David, can you remind us, what are we going to be talking about today?
Sure. Today we're going to be talking about small business private equity. So not just private equity, which will certainly come up as a theme on a number of the shows, but small business private equity in particular, because it really is a different animal than sort of the larger scale private equity that people hear about. So just to remind everyone what private equity is, it's an ownership interest in a company that is not publicly traded, publicly held. So public equity is what people talk about all day long. Private equity is owning part of a business in a private way. And there are four different types of private equity investments. The first is the leveraged buyout, the LBO, which became famous in the 80s, where a firm or a group purchases a company using the cash flows that the company produces as a way to service the enormous amount of debt that they pour into the deal in order to make it happen. The second is venture capital, which is the kind of private equity used mostly for startups. So we have an idea, we need a bunch of capital, we're going to sell equity in the firm to a rich uncle or a private equity firm, and that is venture capital. Growth capital is used for firms that are a little more mature but decide, for example, that they want to open up an office in the U.S. and they need a couple of $1 billion, and it's hard to borrow that because the company doesn't exist yet in the U.S., and so they sell some equity in the firm in order for that kind of growth. And then you get all the way down the road to distressed investment capital, which is really turnarounds, where some people refer to them as vultures, come in and take advantage of distressed situations, buy up the equity, add value, we've talked a lot about that, turn things around, and then sell that company back into the market, either privately or publicly, hopefully taking a nice profit along the way.
And just remind us, how do the private equity players hope to get their money back?
Well, there's two approaches. The one way to get the money back is slowly but surely, which is sort of a buy, hold, and extract income approach. So you might hold it forever, but if the investors have a nice stream of income every month or quarter or year, then they're doing their job. And a good example of that would be a REIT, which technically is private equity because they own apartment buildings and they pull, or any kind of buildings, they pull rent out of that. The other would be the value add and exit through the growth part, where the exit would either be to a larger private firm or potentially to go public. That would be the two ways to extract value out of private equity activity.
Now, on this show, we're mostly going to be talking about mature small businesses and the process of investing into them. When you look at the sellers of a stake in the business or the entire business, what kind of people are you dealing with?
Largely motivated people. What you'll find in a lot of cases is that small business private equity, and I would remind the viewers that if you own your own business, you own private equity because you own the equity in your own firm. That what often happens is that these businesses, the owners of the business, grow it to a nice size, have reliable, consistent cash flow, and yet they don't have a great succession plan. And then what happens is that they'll discover when it's time to sell, as they age and they want to perhaps retire, that there are fewer buyers in the market than there would be in a larger scale because it's small. And that also means that there's fewer intermediaries in the market because people like investment bankers like big commissions, and so the big commissions are not there in the $4 and $8 and $10 million sales. They're there in the $100 and $200 million and the $1 billion sales. And so what all of that means when you put it together is that there is a lack of liquidity in the small business private equity world, which means that when that person wakes up one day and says, I'm 65 years old and I've done this for 30 years and it's time to sell and my kids don't want to take over, I don't have any kids, that it's possible to sell, but the options are not as many as they might be were that business much, much larger.
And so how do investors generally get into small business private equity? Because it's obviously very difficult to do it to invest off your own bat.
That's right. Well, one way that there is publicly traded private equity, and small business is sort of a relative term, where companies such as Onyx, for example, buy and sell what I might refer to as mid-sized companies, not the $20 billion purchases, but much larger than the small businesses that we're talking about. One way to invest is to do it in the undiversified way, which is to go and buy a company. So someone can actually buy a job by finding a company that's for sale, buying it using a mixture of their own debt and equity, and then operating that business. The other way to invest is to invest in someone else's business, which is to buy some equity or provide some debt to a friend who's operating a business. And I've often mentioned to people that if they do that in an undiversified and relatively unsophisticated way, that it's a good way to say goodbye to both your money and your friends.
Right, yeah.
And the final way would be to find a way to have a fund that itself invests in small business private equity, which is an excellent segue into what we'll be talking about today, because Brad Nathan from Lynx Equity runs a firm that does just that. It owns and operates small businesses across southwestern Ontario and provides a way for the average, when I say average, the accredited investors across the country to be able to participate in the gains from gathering those small businesses together.
Well, coming up, we are going to talk to someone who specializes in buying businesses from people who are retiring. Brad Nathan, president of Lynx Equity, is next on Alternative Investing. We're back with Alternative Investing, and I'm here, of course, with David Kaufman, president of Westcourt Capital. We're on the topic of small business private equity today. And we're now going to talk to Brad Nathan, president of Lynx Equity. Brad specializes in buying businesses from people who are about to retire. Great to have you here.
Thanks very much.
And I know a lot of viewers are saying there can't be two guys out there that are this impossibly good looking. And of course, you are the same Brad Nathan who appeared as a judge, a panelist on The Pitch.
Thanks for having me back. Always a pleasure.
It's great to have you here. Could you just explain how did Lynx Equity come about, and what do you do?
Sure. Lynx is a subsidiary of Succession Capital, i.e. the name Succession as in succession planning. We started about 10 years ago through Succession, and then we closed that fund and started a new division called Lynx Equity. And it basically came about because I was in venture capital beforehand and saw a lot of deals that were effectively a greater fool theory. And no revenue, no real valuation, but there was a great story of it can go public and sell to Microsoft. And I said, it's not my kind of thing. I have a CA as a background, and I just wanted to focus on deals where there was real value. I'm a small little Warren Buffett type approach.
And without turning it into an ad for Lynx Equity, though, but if I buy into you guys, what do you issue me?
Mostly debt with some type of participation, depending on the structure. We've also done equity, but that becomes a lot more complex. People like regular monthly checks, and for whatever reason, when they cash them, they like me. And every month, when people become an investor, we give them monthly post-dated checks.
Okay, so we have a board up here of the different types of financing that you use. So you mentioned equity, because most businesses, of course, have to start somewhere with some equity investors. Right. So can you run us through the other types of financing?
We have some vendor notes. So when we buy a business, a vendor will take back a portion of the purchase price in his own debt. And that's structured over 2 to 3 years. I've often said to a vendor, you name the price, let me name the terms. And we'll pay that over time. That's secured by the business as well. And if someone's uncomfortable with that, a vendor is uncomfortable with that, it generally means that he's not so comfortable with the business.
Okay, so I'm selling you, say, a printing business for $2 million. And you say to me, okay, I'm going to pay you $1 million in cash.
Right.
And the other $1 million I'm going to pay you over time?
Over time, monthly checks over 36 months, 48 months.
Okay, so I become a creditor in that situation.
Exactly.
And I guess that gives you a bit of a hammer in the case that anything goes wrong?
Not so much that anything goes wrong in terms of our operational mistakes, but in case there's some kind of fraud or in case there's some, which we've experienced a couple times, unfortunately, in case there's some type of misstatement on the purchase and sale agreement, and we can have it as a holdback. Okay. That's not necessarily the intention, but we do like to be able to pay it out over time.
That's interesting, though, psychologically. If the person wants to completely walk away, maybe that's not such a great sign.
Yes,
and
probably
now,
not for us then.
Anybody watching who runs their own business will obviously know a little bit about short-term debt, so operating facilities. Yep. So talk about, so you own, 17 or 18 businesses.
17.
Talk about how those operating facilities work and how you use them.
Well, I mean, it's very difficult to use short-term capital for long-term purchases, but it does give us a buffer in the operation of the business. And But it's not really used for the purchase of the business. We just like to have it there as a comfort zone for operating. We don't use our long-term capital from our investors for the operating purposes.
Right.
We use it for the acquisition purposes.
And so speaking of acquisitions, can you walk us through sort of the process from start to finish of buying a business and analyzing it?
Yeah, I'll get a call, and you know, we don't look at 100 deals and do 2 of them. We can look at 10 deals and do 10 of them. Very, very quickly we can determine if it's for us. 1, if it's in an industry that's not overly complex. 2, if the purchase price is reasonable. And they'll call us and they'll tell us a little bit about what they do. And if when we'll speak to them a little bit about valuation, you know, somewhere between 2.5 to 4 times in EBITDA. And we'll talk a little bit about terms. And if they're good, we do a little bit of a macro study on the industry, and then we start getting into a micro.
Okay, so just to explain, when you said 2.5 to 4 times EBITDA, so that means that if I have the same example of my print business, and let's say that I make, I do $5 million a year in sales, $500,000 a year in pre-tax earnings, which is what EBITDA means. So you're paying a multiple of the annual earnings.
Yes.
In order so let's say you pay 4 times. So that means that there's an implied return of 25% a year?
Exactly.
Is that right?
Exactly.
And is that sort of where the sweet spot would be in terms of being able to collect the capital necessary to make that purchase?
That's exactly it. That's a perfect example. And, sorry.
Sorry, Brad, I was just going to say, it's interesting. Sometimes the vendor, the entrepreneur who started this business, will downplay his or her own role. So to say, it'll be fine even if I'm not there.
It's a good trick. It's a good trick. We've seen that a few times. They try and normalize the earnings a little bit more by saying, I don't even need to be here. But they do. And we're trying to stay away from a business where it's solely dependent on that owner-operator. It's easier when there's some people underneath him or her.
Okay, so that's interesting. So if you have a service business, let's say an ad agency, a marketing agency, where there's a creative person at the helm and they're the founder and the operator, they can't just give you the keys and have that business operate and walk out the door and move to Florida and play golf the rest of their life.
There's a transition period, and we have to be able to make sure that we can learn that role very, very quickly. And for example, we bought a chain of hair salons. Not that I get much use out of it, but it's called Top Cuts, and the owner, a former owner, didn't know any of the customers. That's a perfect type of deal for us. Unfortunately, that's not always the case, and we have to make sure that we have developed that good relationship with the customers.
Well, tell us about your own exit strategies. How do you like to get your money back?
My principal way is, and so far it's the only way we've done it, is cash flow from the individual businesses. We haven't sold anything that we've purchased. We have no mandate to do that. It's not a greater fool theory. I don't need to take a public for someone else to buy it and increase the value.
So a greater fool means I buy today at $10 and I'm going to find someone that's stupid enough to pay $12 tomorrow with no metrics changing along the way.
Like I believe a lot of the stock market, a lot of stocks are like that. People are paying 15, 20, 25 times earnings on a business without any growth. That doesn't make a lot of sense. Okay, and then your other exit strategies then? Well, we can sell a business to someone else in the industry. We can go public on a business, but we're smaller, and it's a difficult story when you're a $10 million individual business making $1 million. It's not run. The public are not chasing that thing down.
What about a reverse takeover?
We get a lot of calls about that, to do that. But, I like being private. If the right opportunity came along from a public perspective, I would do it. But a lot of people made money historically without having to sell their business to make money. Our size is we're coming close to $75 million in sales and about 10% EBITDA. I'm doing okay without having to answer to a gajillion people. Okay, so that $75 million is coming from a lot of different sources. Yeah. So there must be some pretty significant challenges that come along with that revenue. What are the biggest challenges that you face on a day-to-day basis? Well, for me, it's a capital side. It's making sure that we have the adequate capital and we're managing our cash flows properly, as anyone in business would. And then there are the operational challenges. I'm not there on a daily basis, and we have people who go in and manage these things. But I'm one step removed from the day-to-day. So if there's a problem, it's hard for me to fix it, but we have people who can fix it. Banking was historically very challenging until we met some very good people at Royal Bank who believed in our story. I think the banking system is set up to keep the business small. If you have a house and you have some assets, that's pretty much the leverage you can get. I know a fair amount of people now who are mid to high net worth. They've enabled me to get that financing to grow. Without that network, it's very, very difficult. So take you from that initial level to the next level. Absolutely. So the holidays are right around the corner. You're running all of these businesses at the same time. What's on your wish list in terms of what you want to buy, what you want to sell, how you're going to get access capital? Wish list would be, a decent term loan of about $10 million. That's not too much to ask for.
Andrew, can you pull out your checkbook?
Well, I think so, yeah. I'll have to check my account.
And we have a lot of very good deal flow right now. We're trying to be a little bit more synergistic, and it's pretty easy when you're in 17 different industries to become synergistic.
When you go in, often you're going to have an entrepreneur, they're getting older, and their kids, assuming they have kids, don't want to take over the business. Is that basically the scenario?
Exactly it. As I've said before, I think on the show, is first generation starts it, second turns it into a dynasty, and third throws it away. The parents should plan very early in their lifetime to not give it to the kids.
So the kids might be better off if they pass the wealth onto them and not the business onto them.
Absolutely.
What about boys and girls, sons and daughters? Do you find any difference there? Are the daughters stepping up more to want to take over businesses? Or?
No, in most of the cases, the parents have just not had the kids who have wanted the interest, and it hasn't even been a discussion of the kids going into it. A lot of entrepreneurs whom we've met, their kids just didn't find the same passion, and that's normal. The parents don't understand why the kids don't love making signs.
But the kids have to go their own way, I guess. Yeah. So it's not the younger generation are slackers?
I think the parents think they are.
Yeah, every generation thinks that, I guess.
And so as you deal with those fears, as you compile this list of companies, you talked about synergies just a moment ago. You must develop some synergies by specializing somewhat. You're not really in 17 different industries because you have service businesses and you have manufacturing businesses. And so I presume that some of those synergies are real and not just apparent?
No, they're real. I mean, we aim for real. A lot of times it is a philosophy, but we actually do try and put it into practice. And group buying, we've focused a lot on the sign industry and the display industry, and we do focus on that synergy for that business.
Good stuff. Next time there's a big IPO in the news, we'll have to have you back, Brad, and you could give us a good cynical look at it.
Yeah, right.
Sorry.
Thanks a lot. No, that was excellent. Thanks very much.
Thank
My pleasure. Thanks for having me.
Brad Nathan, President, Lynx Equity. Well, coming up, we ask you to send us your emails, and you have delivered. David will be looking at your questions and telling us what's coming up next on next week's show right after this. Welcome back to Alternative Investing. I'm here with David Kaufman, President of Westcourt Capital. We're going to take your email questions. We've got some really good ones this week. Email number 1 from Brenda in Halifax. She says, great show. I could listen to that all day. Could you tell me more about first versus second mortgages and how they affect the risk taken on by investors? Please explain what I need to know about this.
That is an excellent question. Last week we talked about mix, and we talked about loan to value being the key metric in determining the risk of being assumed by an investor in any mortgage situation. But we didn't talk too much about first versus seconds. So it's the same in the commercial arena as it is in the individual arena, where the first mortgage is the last lost. So when you think about it, the first mortgage is always the most secure. And if you come behind that with a second or even a third mortgage, those people lose all of their money before the first mortgage loses any of their money. So there is no doubt that a first mortgage is always more secure than a second mortgage. But that doesn't mean that second mortgages are a bad investment, because it all comes back to that key metric, as we said, of loan to value. So let's say that someone, to use a residential example, someone owns $1 million house, but they've owned it for a long, long time. And they own enough of the equity now that their mortgage is only $400,000, which is only a 40% loan to value. And they need $100,000 that they want to borrow so they can send their kid on a trip around the world. Well, they can access that $100,000 using a second mortgage. But even with the second mortgage, the loan to value on this property has only reached, in my example, 50%. Still considered very, very secure. So, Brenda, you have to understand loan to value. You have to know about if there are any other covenants associated, meaning that they've given personal guarantees, which would help you if you were a second mortgagee, as the lender is called. And so I would beware, but I wouldn't necessarily say no out of hand.
Email number 2. Last week, you discussed MICs, mortgage investment companies, corporations lending to developers. Are there residential MICs that lend to end users? What is the risk profile for this type of MIC, and is the return comparable to other MICs?
The answer is yes, there are MICs who specialize in end user residential, a house and an individual borrower. We talked a lot last week about the difference between traditional and non-traditional loans, and the three key things were that the borrower, either the borrower or the asset, being the home in this case, or the terms, the interest only, short-term versus long-term, would be non-traditional, or sort of a mix of all of those. And there are individual borrowers of end-user residential who don't fit into the traditional bank, the bank example, but still make a good risk, a good bet to provide a mortgage. So you do have firms. A good example is a firm called Prime West out in Saskatchewan and run by Al Zach, who understands in his area exactly what metrics are important to determine who should be receiving mortgages and who shouldn't. So the benefit you get out of that is they're much smaller mortgages, of course, because they're big commercial industrial mortgages, which means that you can have a lot more diversification. The downside is that it takes a lot more administration because you have so many mortgages to administer. But they can pay about the same amount depending on the example, if there's any leverage used. That's kind of a longer answer, but I would expect the returns to be similar, and it's a bit of a different model.
Email number 3, this one from Henry. Hi, I'm interested in MICs. You mentioned one on last week's show. Where can I get information about other MICs?
Okay, well, first of all, Henry, there are a few publicly traded MICs that you can research, on wherever it is that you buy and sell publicly traded securities. So you have Timber Creek and Frontenac being two examples that are prospectus sold. Mm-hmm. They're not in the exempt market. But most of the MICs are in the exempt market. And so what you should either do is do your own research, which of course is very difficult for people that don't have a sophistication in that particular area, or find an exempt market dealer, an EMD. And what you can do, Henry, is go to the website of your provincial securities commission, and they will have a list of exempt market dealers that are in your province, and then you should do some of your own research on the EMDs to discover which ones might be best suited for you to make those decisions.
Let's talk about next week's show.
Next week we have two guests, actually. We're going to start off talking with Tim Pickering, who's the president of Auspice Capital, who has put together a very interesting model. It's a new managed futures ETF. We talked about managed futures a few weeks ago, but we didn't talk about it delivered in the ETF format. So he'll be in to talk about that. And then we'll be meeting with Andrew McCreath, who is the senior portfolio manager at Century Market Neutral Limited Partnership. And he will be talking about market neutral hedge funds. Very interesting model that I think we'll really want to sink our teeth into, and it'll come back as a theme in future shows as well.
Yeah, especially with the markets going up, maybe not for good reason. People might be looking for a strategy that takes
That's
us from
right.
the market.
It's truly uncorrelated because they have basically a similar number of long and short positions, meaning even though the underlying assets are publicly traded securities, that doesn't mean that you have a positive exposure to the market or a negative exposure. It's neutral.
David, thanks very much.
Pleasure. Thank you.
David Kaufman of Westcourt Capital. We are out of time on alternative investing. Remember, get your emails in, alternativeinvesting@bnn.ca, and we'll be back next Friday at 11:30 Eastern, 8:30 Pacific. Thanks for watching.